All right, loyal listeners, welcome back to another episode of Trades Talk. Maggie Wymore here, and with my co-host Justin White. Today we bring on Zane Terence, a managing director and partner of Founders Advisors. Zane has a lot of experience when it comes to the private equity space, whether it be how to improve your company's EBITDA, how that compares to your growth trajectory, your return on what you can get for your company this day and age, and all of the building blocks and pieces that you need to have in place when you're looking to exit your ownership and your exit strategy of your company. So great conversation. Honestly, I felt like I could talk to Zane all day, but Justin, what were your key takeaways?
Yeah, it's hard to boil them down to just a few because there was so many great takeaways throughout the episode. I think first off, just to set the stage, Zane calls himself a river guide for business owners who are looking to sell or looking to exit, because he's not the private equity roll up that we've talked to a few of those. He's not the platform company. He's someone who has gone through multiple exits. He's built this really amazing, this advisor group that invests in businesses and helps businesses sell. So he has this perspective that few people have, and he understands home-based services, trades companies, and also SaaS at a very deep level. And that comes through throughout the entire episode. I think whether you're a business owner, you're working within a business, you're thinking about starting a business, this episode is going to give you a lot of fundamentals on how to make that business more valuable. Whether you're looking to sell or not sell, it's really important you focus on these key metrics that he shares. So it's nonstop fun from start to end, and a lot of knowledge, a lot of insight.
Yeah, I think one thing you said there is whether you're looking to start a business, and Zane gives a really great perspective on why you shouldn't start a business right now and what avenue you should take instead of starting your own business. So I'm going to leave you with that little teaser, and let's ready to dive into the conversation and let Zane take it away.
Let's go. All right, guys, welcome back to another episode of Trades Talk. We got Zane Tarence here with Founders Advisors. Zane, welcome to the podcast.
Justin and Maggie, thank you all for inviting me.
And Zane, you're from Birmingham, Alabama. Is that correct?
I am from the South. I grew up in Texas, Justin, but so Texas and Alabama. And then I was all over the country in my first career with IBM, but then settled into Central Alabama about 25 years ago.
Beautiful part of the country. So why don't we start there? Why don't you tell us a little bit about your background and how you kind of came up through the ladder of sales and everything else. And then eventually part of this Founders Advisors group, you can kind of give us a little bit of insight on what you guys do there.
Sure. Hopefully this will be helpful. I feel like I'm getting a little bit old, Justin. I'm a tech baker. We have a home services focus as well, but I'm 58 years old. When I started with IBM, and I had 4 jobs with IBM. IBM stands for I've been moved all over the country right out of college. I worked with IBM as an intern as well, but worked for them. My last career with them, 3 years with IBM Global Services. And what kind of changed the trajectory of my career, we invented a product, my practice, consulting practice for Federal Express. Long story short, this was in 1996, and IBM was very into intrapreneurism. They were trying to keep a lot of us in the company. When the internet was coming out, a lot of people were leaving, starting their own businesses, and we had an entrepreneur in play. They ended up funding me, Maggie and Justin, to start my business, deeded over this product that I had invented, my team had invented for Federal Express. It was web-based testing. Long story short, if it's not too late, we left. IBM helped fund us. They gave me the intellectual property. We ended up getting a patent on web-based testing that my own company, Virtual Learning Technology, had. So now I'm an entrepreneur. I've been with a big corporation for 12 years. That's all I knew. And now all of a sudden I'm out on my own, starting a tech company. 3 years later, my investors, IBM and my other venture capitalists said, Zane, you're not a very good operator. You need to sell this business. Hurt my feelings, but I'm so glad they told me to do that. At that time, I met a banker. I didn't know what an investment banker was, what I am today. We did a process to look at raising capital or doing a recap or to selling the business. And we ended up getting 5 strategic offers from publicly traded companies. Being naturally bright like I am, and my board, we took one of those offers. So sold that business in 2000, the patent and everything, to a company called Houghton Mifflin, public company out of Boston. Worked for them, got my earnout. They were wonderful to us. Worked for them, but then I was 35 years old. I wanted to start a venture capital model incubator, so left them. They were happy. I was happy. Started a VC model incubator to invest in small smaller businesses to help them get to the next level. Time of my life there. And in 2007, it morphed into my partner now had started an investment bank. I was on his board, and my practice, my venture capital fund and him merged back in 2003. And now I've been here for 17 years. We built a practice of, I think we have 46 bankers, 12 other professionals, CFOs, attorneys, and we are river guides for privately held companies, typically between 30 million and about 300 million in enterprise value. And we just love it. We work internationally in our sectors. We have 5 sectors that we focus on: industrials, consumer, and brands, which include home services. So if you got pool services or y'all's case landscaping, then we've got tech, business services, and healthcare. And all day, every day, we just do deals for private company owners to help them get capital to grow. And if they want a little liquidity, give them some liquidity as well. And now I'm writing, I travel, I speak. That's the way I met you, Justin. And I just love helping entrepreneurs because I'm one of them. I am an entrepreneur, and I think they're at an information disadvantage. I think they're out there working and wondering, am I really creating value? Am I wasting my time? How does this really work? And so I like bringing founders, the name of our company, Founders Advisors, to really understand what creates value and to help them fit their business goals with their personal goals.
That's great. I have to go back to part in their story. You said you were 35 and you wanted to start this, VC incubator, right? And I'm 35 right now, visualizing this in my head. Why was that the route you wanted to go down? Like, what made you so set? And this is where I was taking my career. What lessons did you learn from selling your own business, partnering with the right person, all of those things, so that this is where you wanted to go?
Great question. I was very blessed. So we had a really nice liquidity of it. Okay. So I had some choices now. I grew up a preacher's kid, kind of not poor, but I wasn't rich, right? Now that I had some choices, it kind of changed my whole trajectory because I didn't have to worry so much about my kids, college and weddings. I wasn't wealthy, but I was rich. And I said, wow, what I have learned through building a company and through the advisors that I was able to have because of who my board was, they wanted really good advisors. I wanted to help companies begin with the end in mind and build something of value and things that I wish that every entrepreneur should know. And also, honestly, I knew these are great investments. The name of my next book, I think I told Justin this, is Don't Start a Business. Buy one and make it better. I didn't want to start another company. That was too hard, but I was invested, Maggie, in really good companies that had good product market fit in the tech world, but then provide them an incubator where I could bring them the right attorneys, the right intellectual property, the right consulting to really increase their value quickly. So I thought I could collapse timeframes for entrepreneurs, and also that would be a very good investment for me and my partners.
Yeah, for sure. How much of it do you think that you were in the right place at the right time too with the tech world?
I've seen so many amazing entrepreneurs not get the breaks they should. It just didn't go well. They were smarter than me. They did the right things. Just the macroeconomics turned on them. Something happened outside their control. Then I've seen mediocre entrepreneurs like me, right place, right time. My mom was praying for my business, and we got a patent back in the days when you could get a patent on software of web-based testing anytime you take a cert. So I was fortunate, okay? But I do believe the advisors I had, the investors I had, sucking off of IBM's brand, they allow me as a startup company to have their brand. That's the reason we sold Los Angeles Unified Schools with my tool, New York City Schools, Miami-Dade. I had some really good partners. So I'm going to say partnerships, and you can use the word luck or blessed.
Yeah, I guess I could see it both ways. And also, it's what you do with that blessing and that luck. Being in the right place in the right time is one thing, and you could take advantage of it or you can let it fall. So
absolutely. And Maggie, I want to say one other thing because I want to help entrepreneurs. At my age, I see this over and over again. My partner's father, that is a super successful person, multi-billionaire, self-made. He says this: it is not how tough you are, it's how long you are tough. In business, stay around the hoop, stay in the game, make sure, you're not in a cul-de-sac. But there's hard times going up a mountain. Everything worthwhile in life is uphill. Make dang sure you last. Don't quit. So how long can you be tough? We did have some tough times that 3 years. And we were able to stay in the game until things turned around.
Yeah, that's great, Zane. I appreciate the background, and it just shows there's so much to this. And you mentioned begin with the end in mind, and that's something that I've struggled with. And watching my dad and mom kind of grow their company, there was never really this thought of an exit or the end in mind. It was just how can we make payroll next week? How do we get the next job to keep the guys busy? It's just a constant grind as an entrepreneur getting started with information becoming more available and the entrepreneur today being more educated for good or worse, right? There's more information, whether it's the right or information or it's not. The idea of exiting your business is becoming more and more popular. But you have a book called The 17 Reasons Your Company is Not Investment Grade and What to Do About It. So I want to talk about that. And I want to talk a little bit about what are some of those areas that when people get to the end and they're ready to sell, they realize, man, my business could have been worth so much more had I done this or had I done that. So what are some of those things that pop out the most to you when you're meeting with these folks and getting ready to help them with an exit?
Wow, great question. And thanks for leaning into that book. It maybe 10 people have read. Now, a lot of them have listened to it on Audible, but I'll tell you, all those 17 reasons are important. I basically took them from just watching due diligence. We've done about 200 or so deals with families from when we started to when they had an amazing exit event. And you see this over and over in the pattern recognition, Justin. But I want to tell you, one of the most important things, if I could write one thing on a billboard of those 17 reasons for entrepreneurs, it's what you started with. What is your personal vision? A lot of entrepreneurs feel selfish if they have a goal. Hey, I want to exit when I have this much money or whatever. Let me tell you, it's not selfish. It's smart to begin with the end in mind with what do I want from my business? Because let me tell you, your business will take everything from you. It will cause you to work 24 hours a day, 7 days a week, stress, get sick, get a divorce. You need to figure out this business is for my family, my stakeholders, my employees, what do I want from it? So determine that. And then you can architect. The first thing is exceptional people create exceptional results. Every business book you read is going to say this, going to talk about it, but the data shows it. And I'm just telling you, the older I get, the more companies I see, your value proposition to your clients is going to be delivered by your people. Your new products are going to be developed by your people, your process, your systems. It is the people. How do you get the best project manager you could ever get in Central California for your business? How can I get the best associate in investment banking in Dallas, Texas, and Birmingham, Alabama? If I get good at identifying, recruiting, and retaining talent and getting them in a culture that's rowing in the same direction, that has a shared faith. Me as an owner know what we want the business to do. I can invite my team members into that vision. They could have to do with their families, money, a great career, a great culture. It is the people, Justin. It is the people. So anytime you spend recruiting, identifying, retaining A players, having your quarterly conversations with, getting to know their spouses, their family, that is time well spent.
I love that answer. And I think we hear that a lot. It's all about the people. And a lot of us have trouble spending time in that area because we're constantly pulled into the customer firefighting. We're constantly pulled into the technology firefighting of our businesses and trying to stay one step ahead. And we never really make that time to sit down and just spend a one-on-one 30, 40, 60 minutes with our team and develop a relation. But I can tell you from experience, I mean, we really started focusing on our people. We always have since I took over in 2015 and my dad had before that. But in 2021, we launched Employee Success Team and we changed HR to what we now call EST or Employee Success. And we tried to really change the narrative around what human resources is. Because what is like, I don't know who invented the word human resources, but it's pretty shitty for what it's supposed to do. And so when we changed it to Employee Success Team, they're no longer responsible for compliance and all the workers' comp and stuff. That happens with our financial side because they're great at auditing. They're great at detail work. Our EST people are almost like, they're almost hybrid salespeople. They're relationship people. They're Chantel, she goes out in the field and spends times with our team because the people in home services and business services, right, Zane? The people are who delivers the service. They're the product. And so if we can help them be better, it's just like a manufacturer or a tech company focusing on product development.
100%. And again, it seems so common sense. And why is it so hard? Justin, you mentioned, and again, I guess I own 8 companies right now that I get, all the boards of that we fund because we invest in companies as well. And then my own company that I work in every day, founders, this is still difficult. I know people are the key, but I still struggle in the day-to-day stream. It just hits you so fast coming on a Monday morning today. And it's like, how do I have time to listen, spend time, invest, and not feel like, I just need to run in my office and close my door so I can focus? Telling you, it's the difference. And it's so funny. Institutional investors who we work with all day, every day, they invest in the jockey, not the horse. They want to put their money in a management team with the right growth strategy, the right end markets. They know that management team will tweak the product line if it needs tweaked, change the pricing. They spend 90% of their time vetting the management team. And because that's the key. So anyway, just watching smart people, it is about the people. Now, there's a bunch of other ones, but didn't know if you wanted to talk about that one more.
Well, I wanted to see, Maggie, if you had a comment, because I know you guys are big about people. And also, Maggie's team's, 50% remote?
Yeah. So I have a team of about 65. I run a business development department for a software company, and about 65 people underneath me, and half are remote, half are in office. So trying to maintain that culture and show that care between, the people I can see every day and the people I don't. And I just had a follow-up comment though. Someone said this to me once, is if you feel like you're not doing enough, you are. Meaning, when you said you want to go in your office and you feel like you can't touch all these people and can't support all these people and recognize all these people and find out what's going on, that means that you genuinely care and you probably are doing enough, and you're doing enough that you can't, to your personal capabilities. It's the people who don't have that feeling of, oh, I'm not doing enough, that are the ones who actually aren't, because they don't care about it enough to even have this imposter feeling of, oh, I'm not doing it. I'm not doing it. Like, you genuinely care through this constant feeling of not doing enough. And I feel that day in and day out. You don't have to talk to every single person every single day, but you do have to, if they reach out to you and say, hey, can I get 5 minutes of your time? Even if it's not a yes, right now works, or it's, hey, can we do it next week? And you stick to that word. So as long as you're making them feel like they're heard, that's all you can really do when your team gets to be so big. And just know that in your heart, if you genuinely care, you're doing it.
I love it. And Maggie, I'm going to have to call you more often where I can feel better. I'm a words of affirmation guy, so I'm trying. But, and I think one of the magic things, and you said this, your A players, your strong people really feeling supported. And I think one of the magic phrases that I've learned, not to manipulate people, not to get what I want, but truly ask this question: what can I do, Maggie, to help you reach your goals? We have quarterly conversations. Here's what you're trying to do in the business. What can I do to help you? What can I do to help you in any personal situations, work-life balance? Just what can I do to help you? To an A player, that question motivates crap out of them, y'all. So I'll just really encourage us with our people to just ask that question often.
And it starts with understanding what their goals are. So take it one step, before you ask that question, where do you want to go in life? Because a lot of times I feel as leaders, we assume that everyone wants to have the same level of success that we do. They want to take their career to a title, a compensation package, all these different things. And A players can be defined from those alphas who want to just go, 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 and constantly build that ladder. But they can also be defined in really solid status quo people.
100%. You need the eagle and you need the plotters.
Right.
A bunch of eagles can be a mix. There can be some egos. You need all types that can be A players. Totally agree.
Yeah, they bring the dreamers like myself and Justin and yourself back to reality. And honestly, we can't get where we're going without those people. So
100%. So exceptional people. Now, Justin, I don't know if you got, but I got another big one that you knew when you and I spent time together. This is a really big one. Once you get your vision, your strategy, what you want out of the business as an owner and how you can help your people get what they want, love on them, take care of them. But then I'm telling you, your business model matters. Some people put a great team together. They have a terrible business model, The margins are so thin, or they don't have this beautiful thing called recurring revenue, where you have to get up every day and pray that you'll get some business today. That's a sucky business. Let me just be really clear. The reason certain businesses trade at 18 times EBITDA and certain businesses, great businesses, big businesses trade for 3 times EBITDA is largely related to your unit economic model. And so I always draw a continuum. What are these 17 reasons your company will never get an institutional investor excited? And you really shouldn't be excited about it either if nobody else is that you just have one time limit. You do a project and then you're done. Versus that's project-based revenue. Move a little further down the continuum, you get to reoccurring, which is a different word than recurring. Recurring might be contracted, might be like landscaping. Every week we come, every month we come, we have this, Spotify subscription, SaaS subscription, Maggie, like y'all, some kind of a subscription car wash. That's the cast me out. It trades like crazy, especially if you have great retention, not much churn. But reoccurring can be a services business to where the patterns of your client when they need new products or services, and it is repeatable and definable, even though it might not be the first of every month, like the utility bill, right? And that trades for, a lot more than one-time revenue. So I would say as you're architecting your business, spending your life, your energy, recruiting people, make sure you don't have a one-time business model. Life's too short. When you go sell something, you want it to go cha-ching. If you keep your clients happy, it just keeps going. Now, every sale is net new. It's net new. It's not like, oh crap, we don't get a sale, we're out of business.
Zane, I couldn't agree with you more. And there's 2 things I want to challenge you on. First is some people are going to say, well, Zane, I don't want to ever sell my business, so it doesn't really matter to me about recurring, reoccurring, or one time. And secondly, I hate maintenance. It's boring, doesn't excite me. So I just like doing that high-end residential install, or I like doing that big commercial project. And so for me personally, maintenance just isn't something that gets me excited. So our business isn't going to explore that at all. And like I said earlier, I don't ever really want to sell, so it doesn't matter to me. I'm using a story I hear a lot. It's not my view, but what would you say to that?
Yes. First of all, I would say I really appreciate that question. I hear this a lot. I don't care if I'm investment grade. All right. It makes a business better to own, operate, run. If you have cash flow predictability, operational predictability, peace of mind, recurring revenue businesses offer you that. So it is a better business to keep running and operate. It's profitable. It's better for your A players who want to come and have a career with you. They can see themselves having a great career. So first of all, if you never wanted to exit, now all of us will exit one day, whether we admit it or not, right? But I would say if you want a great business that supports your family and your lifestyle, make sure it's recurring. So even if you never want to do a deal, if you want to do a deal, it makes about 6 times more value. Now, your other question was, I don't like the maintenance business. I like new products. I like getting out there and it's doing something new and installing a new deal and getting, building this pool and landscape environment, get $1 million and move on to the next one. You're a very interesting person, man, because maintenance is more predictable, where I think you can even add more value to your clients. If your clients are subscribing to your software package, now you can focus on not going to find a new one and try to sell a new customer. You can focus on customer success of your current client because they're paying you $5,000 a month. What else can I do to be net new to that client and even charge more and raise my price? And if you really have a great business, you've got to have pricing power. Warren Buffett says, if you have to pray before you raise prices, you do not have a good business. And so that repeatability in that boring maintenance allows you to add more value to your client versus trying to go out and find another one. So I think it's better for all stakeholders and it's more fun to have that kind of business. And if you just like living on the edge, go get a hobby of jumping off cliffs or something, but in your business, get recurring revenue. That's what I would say.
When I was selling landscape to that sentiment, I don't remember where I heard it. I think it maybe was at HubSpot's annual conference or something like that. And they said, if you can raise all of your clients, your reoccurring clients prices by 10% and only lose like, and keep 97% of them, only lose 3%, then you're doing something right. So if you look at it that way, and honestly, you probably want to lose those 3%.
Absolutely. And Maggie, I would say you should pay those clients to go to your competition. There's some of our clients, we ought to say, hey, I'm grateful you believed in me, but you're taxing my great employees so much. Could I give you $1,000 to call my competitor?
Yeah.
Absolutely.
Yeah. I always say there's 4 things in a healthy landscape or trades business that you need to look at. And when I was, selling Aspire and I was having these conversations daily with contractors, those 4 things were, is the client buying things from me? That's important. Am I performing that business profitably? Am I making money off of it? Are they paying their bills? And then the 4th is what I call the PETA factor, or the pain in the ass factor. How many issues or complaints are they filing with my company on a regular basis? So that you also have to attach revenue and value and expense towards that, because if you are constantly going back out there for callbacks, you're losing money on that client.
Absolutely. And I will say, man, I don't know if y'all have ever tried that pain in the ass V. It's a great way to talk to difficult customers in a loving way. There's a lot of them, own their own businesses and just say, hey, listen, we appreciate you. You're making us better in some areas, but as we look at our market and our team, I'm going to have to assess you a pain in the ass fee. It's so interesting. A lot of clients go, hey, I get it. I'm sorry. I mean, and some of them will say, okay, I'll pay that. And then you really probably want to fire. But yeah, that is a great point.
Yeah. And Zane, you said something earlier too, customer success, and you can actually focus on that when you have recurring services. It's such an opportunity to just level up your services in your market to stay ahead of the competition, because everyone's so focused on the next job or the next client, which if you're in growth mode, you should also be there too. But just don't forget about your existing customers who's funding your day-to-day operations today, and make sure that you're giving them the support they need.
Justin, I so love that. And again, you get to build a relationship with this ongoing client that is invaluable for market research, for what you're trying to do with new product development, new service development, and just listening to them about, hey, are we providing this much value, but you're only paying this much? I just think it's a more rewarding business model than sometimes a project-based business that we all know. We have project aspects of all our businesses. It's hard to knock a project out of the park initially every time for your clients. And sometimes it's because the client's impossible, right? Once you get embedded, what a gift to get to know that client, do pulse assessments of how you can add more value. And what does that do? It makes them so sticky that when your competitor comes and knocks on the door, they'll call or send an email, they don't even think of dating them. They're like, I've already got my people. And I don't know. That's a better business, y'all.
So, and I also want to just draw some attention to the idea of recurring and reoccurring, because it's something that I see mixed up all the time. And honestly, up until you brought it up in your talk a few months ago in Salinas, when I saw you speak, I didn't really think of it. Let's just say in landscaping, this is pretty simple. We have monthly tasks we do, but every spring we usually do a mulch refresh. All right. So the monthly mowing that we do every week, that's recurring. The annual mulch is reoccurring. And here's the thing. So many trades businesses go in, let's take HVAC home service. They change out the HVAC filter in a home because someone called them and said, hey, I need this changed. They do it and they're done, and they go on to the next client. Well, if you're utilizing your CRM properly, and some HVAC companies do this wonderfully, they have made a note to go in and check back with that client in 5 months. Hey, we're coming up on that 6-month biannual change. You want us to come in? Here's, click this button one time, sign and pay. So the reoccurring is an area we probably don't focus on enough as business owners. And it's a chance you could probably add 10, 20% to your business next year if you just focused on all the reoccurring tasks you do. Take note of that, then reach back to those clients a month or two before that happens.
I love it. And let me give you a little financial engineering around that. This is so true with institutional buyers. When they look at a home services business, they will look at all your revenue streams and they will obviously give a higher value to your contracted recurring than they'll give, a lesser value to your reoccurring and a real lesser value to your project work. If you just have the opportunity of that annual mulching or whatever you're doing, the gutter inspection, if you will turn that in to, hey, we have this many customers that need this, here's how many choose this, you can move that revenue stream from a 7-8 times EBITDA to a 12 times EBITDA just by saying, here's the data to show, even though we don't have a contract, this is actually going to occur again at some juncture, right? So just bucketing your revenue and thinking of revenue as reoccurring, it happens again. It's a game changer, man, to your financial.
And so, Zane, before we get too far down this, let's talk a little bit about this. I'm showing in the picture.
Who gave you a app with EBITDA, or did you create that?
I created it online, and then I bought a few of these and gave it to some of my friends because some of my friends who are business owners didn't know what EBITDA was.
EBITDA, that earnings, that cash flow of the business before, your taxes and depreciation, amortization, you're done. It's really the operating cash flow metric of a business. How much cash does your business throw off? The reason it's so critical in my world is investment banking and investments in private companies. It is the way you will trade. It shows how much leverage you can get, how much debt you can get. EBITDA cash flow is unbelievable. I had a client, Justin, it's so funny. We sold his business and then another deal got with a private equity group that had a grow by acquisition model. We sold him for $50 million. He sold 70%. A year and 9 months later, he sold for $1.1 billion. Okay. He came to speak at my conference last year and got up in front of everybody. He said, I am so embarrassed to tell y'all this. When I came to this conference before we did our first deal, I was sitting around the fire with all these investors and I did not know what EBITDA was. They were asking me what EBITDA, and now he's got his own fund. He's running it. So don't be ashamed if you don't know what cash flow is, but EBITDA is so important because it shows me your unit economics, cash flow. What is your, revenue? What's your cost of goods sold? Because your gross margin compared to your cohort, Justin, you got tired of me just preaching this. You'll know if you have a competitive advantage if your gross margin, your revenue minus your cost of goods sold is higher than your industry. You have got a huge advantage. Now, take your selling, general, and administration costs next to see what your EBITDA margin is, right? And that's critical too. And the good news is every industry now pretty much has a lane that says, what's a good EBITDA margin? In my business, investment banking, 20% top shelf. And if you're a managed service provider, 18% is top shelf. If you're a SaaS provider, it's typically 32, 30, the importance of EBITDA margin, right? What's the landscape number right now? Justin, to be best of breed, what would be your EBITDA margin and the best of breed?
Anything over 15%, your top shelf.
Focus on cash flow. Basically, well, I'm not worried about it because I make money or whatever. You need to be worried about it because it gives you flexibility to borrow money, flexibility to do more distributions, flexibility. If you have a ESOP, if you create a company where you're giving some ownership to your key people or giving them options or EBITDA is more important than a funeral. So we've got to focus on that metric, and it's an investment term because it determines return on invested capital as much as anything.
So it is a very important metric. And part of what I do is I help people manage their gross margin, right? Our software takes everything above the gross margin line, helps them manage that. But then there's that next layer you're talking about, this EBITDA margin. And if a business, say they're running an unhealthy EBITDA right now, what are some specific areas where you would recommend them making adjustments in order to improve that EBITDA?
Great question, Maggie. And you mentioned this earlier when we were first talking. There's this relationship between EBITDA and top line growth. Okay. I want both of these to grow. And in your business, in my business, managing the SaaS business, we call it the rule of 40. If you take your CAGR, your cumulative annual growth rate, and every industry has one of these, and landscape, I think it's about 35 because y'all are doing so well in that space. But you take your CAGR, your cumulative annual growth rate revenue, What's your percentage? I grew 20% year over year. Then if my EBITDA margin is 20% in a tech company, I'll make the rule of 40, which is an elite company. If I'm growing 40%, my EBITDA margin is 0 because I'm growing so fast, you destroy profitability because you're hiring more people, investing in more product. So if I'm growing 40% revenue, making 0% EBITDA margin, I still rule 40, 40 plus 0. If I say this year, we're going to just work on EBITDA in tech company, I get the 40% EBITDA because I get rid of some bad customers. I thin out some stuff. I really look at my marketing spend and I get the 40% EBITDA margin, flat growth, still 40%. So the relationship, Maggie, to your question, how is your rule of 40? If you're a value-added distributor, your rule is probably 18. Your revenue growth and your EBITDA, does it equal that certain number? So if you're struggling with EBITDA at all, if you're growing real fast, top line, I'm okay with it. If you're not growing and you're struggling with EBITDA, you got a problem, right? You got to raise prices. You've got to get more tech or something to be more efficient. You've got to invest in CapEx if you're in a manufacturer to get better robots, because you cannot survive on an expense structure that is not kicking off for your industry a healthy EBITDA number. So you got to force yourself to work on this as long as you know it's a relationship between revenue and EBITDA.
Yeah. And I'll add to that too, is if you don't have a good EBITDA, but you're convincing yourself it's okay because you take great care of your employees and you're a great customer service and you're spending all this money, you got nice trucks. You're like, well, I'm not just a high profit business because we focus on other things. It's just a matter of time until you have to cut back on those other things. So to be the best employer to your employees, to your customers, high profitability is key. We figured this out, luckily, a few years ago when we realized our gross margin, 40%, was just not cutting it because the overhead that was required to run our business in California and everything we wanted to do, we couldn't do that at 25% of revenue. We knew our overhead was going to be closer to 35. So we've, over the last 3 or 4 years, have pushed that gross profit up from 41. Now we're operating at almost 53% gross profit.
Wow.
Which is anything over 50 again is your top shelf in the landscape industry. And you understand you have the efficiencies in the field. Your team's able to make more money because you're being more efficient. And now you have the overhead. You have the gross profit that can service overhead where you can do big benefits. You can hire big salaries and build into your service and sales team to then grow fast. So I think if you're a company that is low on EBITDA, the first place to look, cost of goods, labor.
Amen. And Justin, you made a great point. Your people want to know they're on the team, that you're healthy. Your organization is healthy.
Yep.
You've got the right mark. You've got a balance sheet. They're not looking for a flash in the pan or panicking. Oh no, now we're in trouble, cash flow. Something happened back. They want the comfort to know that their company is making money. There's nothing to be ashamed of focusing on EBITDA. Guess what your customers want to know? They want to know you're making money. If you're taking care of them and they love your service, they want to know that you'll be around, because we all know being naturally bright like we are. If I'm beating the crap out of you and you can't service me and you can't get the right sharp blades on the Kubota, 0-ton mowers that I have on my farm that I love so much. If you're not making money, it scares me if you're a value-added supplier. So don't be ashamed of that, but look at your industry norms, because I think a lot of us sometimes say, well, that's impossible. You want me to raise my EBITDA. If I look at your industry and they're doing it, then you got to say, shoot, the problem might be me. I'm in competition sometimes in sports and CrossFit. And I'm like, how in the world at 58 years old, it's impossible for me to do, this many muscle ups at my age, maybe when I was 28. But guess what? When I see around the country, all these people my age doing that, it opens up my mind that, oh, shoot, I can do that. And it makes me work harder. So what you focus on happens. So I love that EBITDA hat. I'll probably need to borrow that to some of my board meetings.
I think one thing the reason I asked about how you improve your EBITDA is I think a lot of times people don't believe this idea that sometimes you have to spend money to improve your EBITDA. And they just think I have to cut. In actuality, you need to become more efficient, and you can grow that revenue, like you said, grow 40%, not change your EBITDA. But ultimately, sometimes it's about spending money. And that's a lot of times the owners who aren't improving their business are the ones who are scared to spend the money.
I know you're a software girl. Tech with private equity groups that invest in companies, they're all about EBITDA. They're not scared to spend on tech. Guess what else they're not scared to invest in? The right consultants, because they know they're worth their weight in gold, right? And so you're exactly right. Manufacturers, they're not scared to buy new equipment that can have a 300% increased output with less defects.
That actually tees up my question. Like the one question I had for you today, there's a private equity in the trades is booming right now. And what I'm hearing is more and more is you need to be on some sort of software platform to get a better return on your business. Two-part question here. How important is it for a company to not only have tech in their business when they're going to look to sell, but also to prove that they operate that tech efficiently in their business?
In the trade, like you're talking about, we call home services, our sector. You want to be a tech-enabled services business. You got to prove this. You can't just say the words, but you want for investors to really pay up. We just sold a pool services company, y'all, for 18 times EBITDA. If you see the way they're running their fleets, the way they're hiring their people, the way everything's on, the way their portals, the way the people pay them, the way they look at the portal and say, look how your pool's doing. They are a tech-enabled services business, right? We just sold a roofing company for 12 times EBITDA. That doesn't happen. Maggie, to your point, tech-enabled, the way they manage their W-2 workers, 1099. So tech is everything. And I would say connecting, to be very specific to your question, your ERP, whatever your system of record is, connecting that to your operational systems, your CRM, your fleet management, your maintenance records. If you can connect your ERP to your operational systems, and I can show how this affects my financial metrics, it gives a business what, if you want to get me excited, I'd like to do a backflip right here. It gives your business operational predictability, because that tech shows me when I move this, here's what happens. It gives you the ability to operate your business at a very, very detailed level. If you don't have that tech, you don't have visibility. And now let me say a dirty word and a good word. I'm scared to death of this, and I'm energized by it. AI. If you don't have your systems and processes and your data highly technically organized to where you're kicking off data that you can put a data lake to let AI determine where are there opportunities here. If you're not automated enough to have the right data set, it's accurate, that's fulsome to leverage AI, you're going to be a big, big trouble because your competitors are going there. And so, Maggie, tech is everything. Investors look at it, and it's really the excellent implementation of tech. I can't tell you how many companies I see have a lot of tech, but they haven't really implemented it very well, right? Oh, I got this, yeah, but it's not talking. So it's hard, but it's a way to differentiate yourself. And you want to be, again, let me say it again for the slow among us. It might be on this podcast, not us on this podcast. Maybe somebody listens. Be a tech-enabled services business. Be tech-enabled. So great question.
I just want to let our listeners know that I did not cue him up for this.
Oh, but you hit a strategic nerve. As you can tell,
Yeah.
that's a strategic nerve. People come to me and say, I want to do a deal in 3 years. I'd say, let's get operationally solid, then automate. Please don't automate when your processes suck. Get your processes down and then automate, because it will double and triple the value of your business. And I'm sorry, your big competitors are going to kick you in the butt with AI if you don't have your data set clean.
One thing that you said that's so important too is a successful implementation of tech. Because going to your thoughts on processes, when I was implementing tech at landscape companies, when I was doing implementations for Aspire, I noticed so many people within the business were doing tasks that were outside their lane. So not every single process is going to be defined and outlined perfectly when you adapt and bring on tech. But what tech's going to allow you to do is see like, oh, should the accounting person be approving hours for payroll of the people in the field? No, that should probably be the person who works with those people and knows when they showed up and when they went to doctor's appointments and when they left early and when it rained. It should be the production managers. And so many businesses in the trades have people doing the wrong things. And it comes back to this idea of control. Who wants to control the process to make themselves look more valuable to the business when ultimately it's hurting the business? These companies, I know you talk to a lot of different companies in your area, some, looking to sell, some, maybe not looking to sell, just mentoring. But what are your thoughts on all this?
No, it hits right on. I mean, Zane's book, 17 Reasons, why your business won't sell is spot on. And I have a little, he left me a little sheet that has these 17 reasons I keep next to my desk because these reasons are KPIs. People are like, what are your KPIs? What do you track? Well, for me as a CEO of a rapidly growing business, I'm tracking enterprise value as some of my most important KPIs. How do I track enterprise value? Well, EBITDA is a great one of those. And by the way, we report on EBITDA every single month. People think you have to only do it once, you can only do it once a year, Well, no, you can actually create a depreciation schedule. You can do all this stuff and pull it out and back into your EBITDA monthly. And then you can come up with other factors. One of the things I track very closely is fleet and equipment expenses, what we call our operations. And operations expenses in 2020, we were typically 10% of revenue. That was standard. It's an industry standard, I would say. As of today, we're 6.5% of revenue. So that 3.5% is found money. The only way we found that money is through technology. So to your point, Zane, it's technology enabling so we can track our equipment better. We know when it needs to be turned over. We know when it needs to be maintained because we have everything tracked. And our team is now managing that technology versus managing the day-to-day fires. But when I talk to people who are looking to sell or larger roll-up companies that are looking to grow by acquisition, one of their main focuses, its culture is always number one. So that's just a no-brainer. We talked about that earlier. And number two, I think, is EBITDA. But number three, I think as of today, is technology. And technology being a proven record of enabling technology into your business, integrating it, and then operating it successfully. Because that proves to them your company can handle change. And a company that can't handle change should probably not be on the list of an equity roll-up because they're going to have a hard time with that.
They're going to have a hard time growing, going to have a hard time growing by acquisition. How do you purchase another company if you don't have tech? And again, one of my favorite words, because as an investor, this is their favorite word, scale. How do you scale? If it's manual, if it's people, if it's throwing more combinations of permutations, that's what tech was born to do. I really, really encourage that. And I want to say something else, Maggie, and this is kind of stepping out, but I'm seeing more and more. I'm a SaaS guy. So where I'm a software engineer, so where I grew all my businesses that I've sold were SaaS. And two, I sold to public companies. SaaS alone, software as a service, just take this software, Justin, apply it to your landscape and business, make it work. That's tough. I'm seeing the model nowadays. If I'm buying software, we're just doing a huge Salesforce implementation. We had another huge CRM, but we're moving to Salesforce. I've got a group that are experts in Salesforce, and it's CAS, consulting as a service. They're here working on our projects, working on the next thing we want to do, working on the next set of APIs. I'm paying for software monthly, but I'm paying for experts that can help my business implement in my team that software correctly. Think about that. Don't just think about software investments. Think about the people to come in and help you implement it, get it embedded in your workflows, and then you can scale.
Yeah, and my follow-up to that is, it doesn't have to be the shiniest, prettiest, most expensive tech out there. It has to be the right tech for your business. So I just want to say like a tech for a $1 million company is going to look very different than for tech for a $50 million company. And so I know we have listeners who are all over this spectrum. Just start somewhere, because the one piece of advice I can give to you, talking to companies that are all over this scope of revenue size, is companies who start somewhere with tech and as they scale and grow, improve that tech, are far more successful in like the implementation of the shiny, prettier, more expensive tech, the Salesforces of the world, than those who are just trying to jump from no tech to the shiny piece of tech. So start somewhere if you're in that, $1-2 million side of things, and eventually scale your business to the enterprise technology.
100%. Great investment. And again, I think a lot of us are intimidated by that tech because we think we have to do it all, but you don't. You can get the people, the methodologies, and the software in your industry. That's the cat's meow, and it increases value like crazy.
Yeah. And I'll just quick shout out for the Herring Group. If you're in the landscape industry, Greg Herring puts on an annual benchmark webinar, and he goes over all the metrics that you should be looking to shoot for. So Zane, when you talk about industry standards, if you're in the landscape industry, he's got some great resources out there, and they offer a lot of that type of CAS services. So before we wrap, I want to get to one thing you said at the very beginning. You said, buy a business and make it better versus a brand new one. And I know there's 10,000 boomers. I asked ChatGPT, this is what it said. There's 10,000 boomers retiring every single day. And there's a lot of them. I don't know the percentage. I don't want to make it up, but there's a lot of them who own businesses.
12 million businesses in North America, basically Canada and the United States, I don't know about Mexico, that own businesses, baby boomers.
Wow. Okay. Well, there you go. You have some data. There's a lot of businesses that are actually going to be just dissolving or going away or trying to sell, but not being able to sell, whatever they end up doing. And if you're a young entrepreneur getting into the game, you've grown up with technology, you love AI, you're ready to use it. What's your advice, or what would you say when we talk about buying and making a business better versus starting from scratch?
Yeah, I gotta be careful because I believe in entrepreneurs. I am an entrepreneur. I was blessed by entrepreneurism. But again, today's market is so tricky. To start a business from scratch, for me to start a landscaping company and try to compete with you, Justin, that's not what I'm going to do. It's just going to be too damn hard. I'm not supposed to cuss because my dad's a preacher. Can I say it again? It's going to be too damn hard to start it from scratch. And my perspective now, and I've really created more wealth for my investors and us, even in our investments, in finding the team, finding the group that has the business model, finding the group that has the product market fit, the pricing power, the defensible moat, all these things, right? But they're 68 years old and then forgot to get their kids involved, or their kids are doctors. They don't want to do the landscaping business or the fencing company. And when people have a business, it's good. They call it a business down here, Maggie. Damn, a business is probably doing about 10 million in EBITDA. But if you can find those groups, person did a fantastic job for the time in history they live. But what if you can go in this great little business doing $3 million in EBITDA, and you can look at it and say, oh my goodness, all these things we're talking about. You can add tech. You can really put some cool profit plans in place, recruiting, CapEx, more recurring revenue streams. You can change a couple of pricing models. Man, you want to talk about creating value. You might buy that business, landscape business, for 5-6 times EBITDA. The second you move it on your platform, it's worth 12 times that EBITDA, premium EBITDA that you bought for 5, maybe a seller of 6, becomes that person's fine. They made enough money, but at their age, just like my age, I don't want to go and take a lot of risk now. I'm already rich. Why am I going to go and start a new business? But I might not do all that to my business, but I'd be happy for you to do that if I can get it. And guess what? I might finance it because you're probably going to take better care of my people, my customers, with all your new tech, your better mortgage, better equipment, your better systems, your feature set of services is better than mine. So if I were 35, knowing what I know now, I would absolutely go in the niches that I know very well and the subject matter expert in them. And all I would do is put capital with these baby boomers. And so don't start a new business. Here's the other thing. It's too hard. It's just so hard to get new customers nowadays. It really has to screw up for you to get a new customer. Mm-hmm. Go buy somebody's customer base and give them more product, more service, raise the price, because you can do that if you give them more value. Yes, and yes. That's what I would do. I'm telling kids, I got 3 daughters, y'all. And some of the sons, not 2 son-in-laws, that are awesome in their business. I tell them all the time, go buy a business. Just be looking. Look for that HVAC, that pool services. Look for this business. Let's go buy it. So Please, that's the way to do it. And see, all the reason you're getting all these notes, Justin, for these private equity groups, oh, we want to, oh, we want to buy. They don't want to start it. They know how hard it is. They want to buy you and help you grow 20 times. So I'm a real fan of that, brother.
I love it. That's
so
great.
much passion coming through there.
I know. I wish I was 35 years old. I might go do it. But hey, I'll definitely invest in you. I invest in people that do that. I don't want to do it. That's still too hard for me to go integrate a business. But I'm telling you, I would not go to college unless you made a 35 on your ACT or perfect score on an SAT, and you got, the top schools in the country to go to because you want to cure cancer. If you just want to have a wonderful life and you love business, I would go become a subject matter expert in a niche market that's hot. And I would go buy a business of a 70-year-old. You work with them for a couple of years and say, I'm going to bring that's what I would do instead of going to college.
That is so powerful. And you mentioned something, you'd put capital to work. And I think a lot of people are listening and saying, well, I don't have any money, Zane. And you said two things. First, you said the owner will most likely finance you because they want a giant tax bill. And you said a second thing, you'll invest in them. So, I mean, there's so many opportunities to get capital, not just from the existing owner, right? Seller financing, but from industries and places like yourself. There's just no excuse not to explore this.
There's no excuse. And let me tell you another secret in the market. There's a huge angel network in every major MSA in the country, metropolitan area, TV market, of people that made their money in businesses and they're sick of the stock market, certain real estate. They're over allocated. They made their money in private companies. They know what makes a company valuable. They want to invest in private companies. Guess what they need? Entrepreneurs that look like you two, that are your age, that are smart, that are humble, hungry, and smart as Patrick Lencioni says. I see something in your background, Maggie. They're looking for people like y'all to say, listen, go find somebody. I'll fund you all day, every day. There's so much capital out there for young, and I'm sorry, age matters. Because at my age, I don't do it. I don't want to take risk. But please know there's so much capital out there, Justin, to invest in a team to do this.
And that's old saying, your net worth is your net worth. And that's what we're talking about, right?
Yeah. That's it. And that's it.
So, and for the age matters thing, age matters. And I'm going to tell you why age matters to me. And Justin and I are in very different situations. He's got a business to support and run. You can see in my background, I got 3 kids and I can't lose. I can't fail. I have to support my family. And so I'm in this stage of life where, I have to work hard to make money, and there's no option for failure for me. I'm not living off the government. I honestly don't even trust the government right now. So
I love you, Maggie. And Maggie, we sometimes don't get to this because we're just not humble enough and transparent enough and vulnerable. You can't afford to start a new business with the risk.
Right.
Those babies, you cannot do it. You've passed your window. But guess what? A real company that's you can make better, we can get it funded and you pay yourself, right? You still own it, but you pay yourself. You get it funded to pay you. A startup is too brutal to get funded.
Right.
I can fund a company that you're going to go in there with your plan to take the base and make it better. So you fund yourself a salary. You fund yourself benefit. No investor is going to go, Maggie, you need to work for free. Oh, you can't get talent to work for free. Now you might work for, market salary, but you're going to own the equity upside. So that's the ticket.
Yeah.
It's the ticket. And again, if I had waited 2 more years to leave IBM and start my company, I would have never done it because I was hooked. I was making great money at IBM. I was on a good track. I would not have ever left if I didn't leave when I did. But I knew I could go back and get a job if I needed it. But nowadays, I look back at the risk I took and all the money of investors. It was too much risk. I should have bought an educational company. Made it better.
Well, we're kind of hitting our time here. A lot of great insights. I mean, I feel like I could talk to you all day. I have one final question, and it might be the most controversial question before we get into our trades talk, but being from the South, you live in Alabama, you lived in Texas. Who's the football team?
Hey, unfortunately, it's Auburn. So I wish I could say Alabama. I wish I could say Texas, but everybody in my family went to Auburn. My dad was a professor there. My father-in-law was a professor there. I'm an Auburn guy. And here's what we say, Maggie. Everybody makes fun of us in Alabama because, most Auburn fans actually went to Auburn. A lot of Alabama fans don't know, never been to that school. They just like the winning. But we say Alabama fans love Alabama football. Auburn fans love Auburn. I gotta take that. I gotta take that to my Alabama.
I knew it was gonna get him fired up. All right. Well, let's end every episode like we do with our trade secret. You've shared a lot of one-liners and information with us today, Zane. But if you had to leave one message, exit our episode with one message for our listeners, what's your trade secret today?
Ask every owner I've ever seen that started a business and did something great. They had no ask reluctance. You will be amazed if you just ask people to do things. There's a great prophet that once said, ask and you shall receive, seek and you shall find, knock and the door shall be open. If I gave y'all an example of companies that we ended up doing big deals with, and they talk about the times they most went out of business, what changed? What happened when you were about to go out of business? Now you just sold for $110 million. They asked for help. And one example, I had a friend the other day that dreamed, said, man, I want Mark Cuban to come speak to my class one day of high school students. And I remember when she told me that, I was like, that's hilarious. She lives in Dallas. That's hilarious. Can you believe that Mark Cuban, 3 months ago, went to her high school class and spoke? And you know why? She picked up the dang phone and asked him. Wow. So my trade secret is ask, and you will be shocked at the people that will say yes.
Love that.
Me too. Well, thank you so much, Zane. I'm going to leave our listeners on that because that's just a great way to end the episode. Ask.
Yeah. And Zane, before we finalize, is there anything, I know people can find you on LinkedIn. Is there anything coming up, books, otherwise, you want to throw out there for our listeners where they can find more of this content?
Oh man, thanks for saying that. And I love adding value here. I mean, Zane is such a weird name, Zane Tarence on Google, but I am coming out with my book, Lord willing, in the next 6 months. Don't start in business, but I want to make it better. So that's the one I'm coming out with. Hopefully I'll get it done in the next 6 months.
Hey, outside leverage. You just shared it on the podcast. And now it's out there, baby.
Hold me accountable.
Awesome, Zane. All right. Well, thanks so much. You guys have a great rest of your day. Thanks for being on.